one of the key points that we keep on coming back to in our discussions with clients is our view that the Fed in particular will keep rates high throughout this year, keeping them around 5 to 5.25 over 2023. Now that stands in direct contrast to market expectations of quite aggressive cuts in the second half of the year, with the Fed funds rate priced in for around 4.5% at the end of the year.
We're somewhat skeptical of this imminent sort of move to policy loosening. And really, there's sort of two broad camps to that view. The first is really on the macro inflation side. And whilst we're certainly of the view that headline inflation rates will probably tumble reasonably sharply over the coming months, it's really worth noting that that's going to be mainly down to energy and food. And whilst core inflation will probably fall off somewhat, particularly as some of these energy effects filter through to core prices, we're still expecting, as you're getting towards the end of this year, for core inflation across most of the advanced economies to be somewhere in the region of about 4%. So in a historical context, that's still a long way from something that any central bank is going to be considered to be consistent with target.
What I'm showing here is Fed and other central bank policy rates compared to in 2 years' time compared to now. So what's the change from now compared to sort of in the next 24 months? And as you can see here, we're expecting the Fed to cut rates, so the market is expecting the Fed to cut rates by about 200 basis points, versus only a marginal changes for the ECB and the Bank of England. So for me, the outright, first of all, the conclusion from this, and this is what I've been telling clients for the last couple of weeks, is that if the Fed pricing is right, then the ECB and Bank of England isn't. So this is a square that sort of can't be circled, or vice versa, if you prefer. And the reason I say that is because, as Ben mentioned, our Fed call is definitely for no cuts in 2023. We think the inflation credibility would be lost, would be tremendous, and also I think the Fed would like to see positive real rates just to begin to happen as we progress through the year. So no cuts in 2023, but by 2024 we sort of begin to converge on the market's view overall after 2 years, simply because we expect a steeper rate of cuts in 2024. So probably not too much of an argument at a 2-year horizon with the market in terms of that view, but then from a cyclical perspective, from a historical perspective as well, that doesn't tally well with what the market's view of the ECB is and the Bank of England is. If you just focus on the US, and given what I've said before, I think duration, it really makes sense at this point. So, in past cycles, including cycles where we've seen significant sort of inflation in the 1980s, the 10-year yield tends to really do well in terms of the price after the Fed peaks. And now we think we're in that peak. We don't have a June rate hike priced in anymore after the recent Fed meeting. And so, we think that this current cycle is going to be true to historic cycles, and duration will be a very good play.
Some form of US recession is almost everyone's baseline. We believe rate cuts are not imminent, and plenty of unknowns like Russia, Ukraine remain. That said, though, we like, I think in relative terms, EM assets versus DM. You'll see that in our asset allocation globally, we don't favor lots of risk assets, but in EM, we do think that the combination of attractive valuation, good macro momentum in many major emerging markets, and the balance of risk makes it worthwhile looking into EM assets. And in particular, we think that the most compelling story is one around inflation and how it relates to the term premia we see in the market. We believe that EM disinflation is on track. We've had upside surprises in the last few months, but the turn in services inflation is happening. Institutional frameworks have not suffered from the last few years of unconventional policies. There are known cases like Argentina Turkey, South Africa to some extent, where we do see fundamental institutional weakness. But in many other places, even in Latin America, where the shift to the left is very apparent, you still have solid central bank independence. Hence, we think that it makes sense to have exposure to falling yen inflation.